Alright, I had a request on my TVIX video to overlay it on our chart. Now this looks like a super mess, but we're going to find out some interesting things right now. Looking at the TVIX as a leading indicator and an inverse indicator against our S&P. This is Brian Lewis with MMT Investing, and things just changed. So here we have the red TVIX looking crazy, and what you can see here is that this kind of zone on the TVIX here around 40, this is calm and normal bull market trading area. And when you get up here, as you go up into the hundreds, it's starting to get scary. 200 is straight up scary. And I mean, anything up here is just insanity. Like this goes up almost to 1,000. This is crazy, crazy. Like 200 is scary. 100 is pretty getting bad, and down here around 40 is where you're looking to go back into normal trading behavior. So this is just a look at the TVIX, and I think the coolest thing to point out here is going to be the consolidation areas. So yeah, in the last TVIX video, I covered a couple of reasons why going long the TVIX for the very long term is not wise, and this is not investment advice, but it's mostly because the TVIX smashes that like button right now to help me out with the YouTube algorithm. It's because the TVIX is it's not an ETF, it's an ETN, which means that exchange traded notes have no backing. There's no actual collateral behind the thing. It's just a debt security with counterparty risk. Secondly, we have the contango situation that we saw with the USO oil, where because of the way that futures are built into the ETFs and the ETNs, you can actually have the price of this thing go lower than the underlying values with an ETF, or with an ETN, there's no underlying anything. It just goes negative to the futures, and you can get a squeeze on the contracts. You get a long squeeze, and it can go really negative. So there's the risk of a long squeeze with the contango on these kind of things if you're long term on them. And the last thing is just the compounded math. When you have a leverage, like this is a 2x, when you have a leverage thing, every time that you go up and down with the volatility, the down, there's an extra little couple percent, and you keep adding those little extra couple percents to the down, and you're losing money all along the volatility. So those are the reasons why going long on a leveraged ETN like the TVIX has risks and drawbacks, and those apply more to long-term trading. If it's a very short trade, it's less of an issue. But I covered that last video. But this video, I want to do this overlay. Someone asked me to do this overlay, and I wanted to point out that it does relatively mirror the movements. Like it kind of goes up when the S&P goes down. You know, it kind of goes down when the S&P goes up. But there's a couple things to point out. It doesn't just do it like a mirror image. Like down here around 40 is normal volatility. And then as we're getting down here into this crash, this is the first consolidation area where you see this wild volatility here. And this is on an Elliott wave. This is a 1, 2, 3, 4 crossover, and then you get the 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3 consolidation. That's an ending diagonal Elliott wave, and when you get that ending diagonal consolidation action, the TVIX freaks out, and it freaks out before the consolidation ends. Here you can see where the TVIX drops back down, and that's the end of the consolidation period, and the change in direction happens after the TVIX drops down. So it's a leading indicator on a consolidation ending diagonal pattern, and we're going to see that in a big way in a second over here. But then you get this inverse trading pattern. So this is kind of a bear market indicator. We get from peak to peak on this bottom, on this bull trap, we get from about where are we, 120 to this peak over here, which is about 103, so it's almost sideways, a little bit down across the bull trap. And then we get a little bit of sideways movement out here. And then once we start our back test and our legs down over here, it's flat kind of across this back test, starts coming down. And then once it breaks all the supports and finishes this last back test, then we start getting this increasing volatility on this downward movement. Here we get another little consolidation zone on the small wave here, and you can see the TVIX pops up and it comes back down at the end of the consolidation zone. And then we start going again, and the volatility is increasing this entire way down. So this just means the market is just getting scarier and scarier as the volatility is going up here. And I mean, we get up to, 200s, 300s here. And then we get into the consolidation zone, and the TVIX just goes absolutely insane up here to 1,000. We're in the middle of this consolidation area. And you can see the first little consolidation here where it started to consolidate and it started to come down. And then we got a reconsolidation area, a second one, and you can see it just went absolutely freaking nuts. And then at the end of the consolidation area where we switched into our new tangent, it drops. It drops, and then we get the wobble. And during this kind of, I call this area the speed wobble. It's just like the wild movements that you get after the consolidation when you're trying to relocate the next tangent line. And the TVIX is coming down off a mountain during this consolidation area and kind of swinging with these waves, inverse to the waves and swinging. And look where it comes down to once we find our new tangent line, like way down here, back down to the 200 range. So that is a massive consolidation area, a swing wobble, and then finding the new tangent. And the TVIX is a killer leading indicator for that exact type of movement. And we're going to see a few more of those in this cycle. And the TVIX is going to be awesome for that. So you can see it just goes absolutely freaking insane when you get into this consolidation patterns. And it does the same thing on the smaller scale. I mean, if I scaled this up, it would look crazy too. But these just look small because I'm on this big one. But if you follow it, the TVIX knows exactly where the consolidation happens, and it knows exactly where that swinging finds the new tangent line and it hits a bottom, and then you can start kind of swinging against the waves again. And so it's up when it's down, it's up when it's down. It just starts doing the inverse thing over the next bull trap here for the whole bull trap. But you can see the same kind of thing, like from the bottom peak, like we had on this one, to the top. It goes, well, the bottom peak is kind of here. But you can see that over the bull trap, it just kind of goes down a little bit. And it's from 4 to 200 range. And this one was, whatever, 120 to 100 or something. So it's just kind of going down. The volatility is like calming down a little bit here. So we want to see if we get another down leg, like this leg here is a good analog. Like this is the end of the last bull trap, and the down leg, and we get a little consolidation and down leg. So the TVIX was going up that whole down leg here, and it got a big jump on the consolidation. It gets another spike on this consolidation reversal here. So these consolidation areas where it spikes and drops are good indicators of reversals. And that is what the TVIX can tell us. And it's really, really good at consolidations. And I mean, you can watch the consolidation patterns without the TVIX and try to figure out reversals also. And the TVIX is not going to indicate when you get these wild swings after the consolidation. All this stuff, I mean, this is crazy stuff. And I guess let's see what it actually does during those things. Yeah, it's not really pinpointing the bottoms or anything like that. I guess it goes, yeah, it's down when this one's up. It's up when that one's down. It is down when that one is up. So it swings inverse to those things, but it's not a leading indicator there. It's just doing an inverse pattern to the movements that are happening on this. But it does chill out when you get back onto a normal tangent line here. And we've seen the volatility decreasing over this bull trap. So this is calming it out. And if we get a reversal around here, it doesn't indicate, like on this one, we didn't get a good indicator of a reversal. We were already into the down wave when it started picking up. So it just kind of gradually starts swinging into the up, into that movement. So, I mean, if it's, I don't know, it's just kind of doing inverse behavior right now. It hasn't started going up. We would probably be into this down movement and it would start swinging up a little bit. And it wouldn't be a very good indicator until we get down to a consolidation zone, like leading into like a dead cat bounce. If we get a little consolidation action, then the TVIX would spike up like here, and it would calm down before that reversal. So that's a good thing to look at. And that is the TVIX, and that is an unbacked ETN with counterparty risk from Credit Suisse Bank that you can go long on if you like. This is not investment advice, but I don't like going long on that type of thing. The trick that I was talking about at the end of my last video is that because you lose those compound percentages all the time, you can actually short these things, and that goes to your advantage. And there's not an inverse to the TVIX, but you can usually short, like if you were looking at going long on an ETF, like an energy ETF or something, instead you could short the inverse ETF, which is basically a long position, but those percentages on the volatility don't go against you. So that was the trick that I mentioned in my last video. And why ETFs are crazy, because you can get the contango situation and you can actually have the ETF worth less than all of the underlying assets. So ETFs are a little bit crazy. You get counterparty risk, you get these futures risks, you get these percentage loss risks. There's a bunch of risks, and most of those things are better when you're shorting them. And if you're in a kind of bear market down cycle, that's what we're looking to do. That's what we're looking to do is find these moves and short these ETFs on the way down. And then the longs that I like in this cycle are not ETFs. I like oil tankers. I like gold. You can check out my oil tanker and my gold videos on the up moves in this cycle. And then, of course, sometime in June or whenever, when we get out of this credit contraction cycle and we get this expansion growth phase, all the fundamentals completely switch again, and we're going to have to go back and rethink absolutely everything and go long on things like tech and stuff that people are going to hate by the end of this cycle, and it just all switches again. So welcome to cyclical analysis, and welcome to the macro investing view on all these things. And oh no, I got another wiggly snake that's stuck on my cursor. So my little worm friend here says happy trading, and please hit the like button. And yeah, keep an eye on the TVIX. This thing is useful. It is very useful. And hope you enjoyed this TVIX number 2 overlay. Happy trading.